All right, welcome to the live stream. My name is Kyle. Here with me is Dan. How you doing, Dan?
Awesome. How are you?
I'm good. We're going to cover some home buying questions today, and then also talk about a little bit of what's going on with the Fed, our expectations of what's going to happen with rates, and Dan's going to cover everything that you need to know about inflation, the Fed pivot, and then also we covered this a little bit on our last stream, but why rates aren't likely going to go back to like 3% when the Fed changes pivots on the Fed funds rate.
Yeah.
Rates are probably not going to go back down to 3%. So we'll explain that a little bit as well. So if you do have questions about the market or inflation or just in general about home buying, leave those in the chat, and then we'll pull them up on stream and answer your questions. And then also, if you don't have a question, just let us know where are you looking to buy, what area are you in, and how are you feeling about that market? Are you in a market that feels like really aggressive and intense, or so far does it feel maybe like neutral, or you're able to find some homes that you'd like? We'd love to hear the city that you're looking in, and then also how you're feeling about that market. So leave that in the chat. Dan, do you want to cover?
Hey, what's this? You put a new icon up there.
You found
Tell
my
them
little
what it
sticker
is.
up there. Yeah, maybe that's a good, I should probably explain. Yeah, so Dan and I are licensed with ServBank. So we work on a team inside of ServBank. So I figured we should probably tell people and put that right up here. So we're not some like a big call center. We're just a local lender that happens to make some YouTube videos that people watch nationally. And we work in all 50 states. So you want to jump into what's going on
Yeah.
with economic data and rates?
Here's the conundrum I have. Rates just dropped to 6.99%. We'll give that a thumbs up. But the Federal Reserve has been basically on all over the circuits right now. They're on radio and YouTube and TV and everything else doing their bit. And they're telling us, basically, it just came across the wires just now that the Chairman Powell isn't going to wait till the inflation number does hit 2% before he cuts rates. So that's telling me they're going to cut. And all the analysts and even Federal Chairman Powell himself basically came out and said in September, we're probably going to cut. And rates, I thought rates would basically plummet, the stock market would go crazy and everything else. But it's eerily silent, and I can't figure it out. Colin and I were talking about that off camera right when I came on, so not really sure what's going on. So the expectations are they're gonna cut rates in September, but I just posted a video. I think it was this morning or yesterday, talking about how bad the federal deficit is. And as a kid and when I was younger, I never gave a shit about any of this stuff. And so, as you get older, you start to really pay attention to this stuff. So now what I'm seeing is the federal deficit's huge. And the video was posted this morning. And check it out. It's pretty cool. There was a person in Congress actually questioning a person that sits on the financial committees, and he's like, "Okay, what's our deficit?" And so forth. The long story behind this is our deficit is huge, and basically we're printing more and more and more money daily, and those bonds are hitting the market in trillions. There's not enough investors right now to gobble up all the mortgage, all the bonds. When the government spends money and they don't have the money to spend, it's called a deficit. How do they fund that? Well, you and I put it on a credit card. What they do is they issue bonds, okay? And they're pumping out bonds by the billions. So also what happens is mortgage rates are determined by a mortgage bond. So we have the mortgage bonds in the market as well. So there is tons and tons and tons of bonds in the market. That's where we're seeing yields going up and up and up and up, because investors, to buy these bonds, they want higher yields. Okay. And that's what's happening. So even once the Federal Reserve pivots and starts to reduce rates, I don't know how far mortgage rates are going to go down. I'm still predicting them to be in the mid sixes by the end of the year. But I don't know how much lower they're going to go because of all this spending. So please pay attention. I know it's something you guys most likely just goes right over your head. Pay attention to the federal deficit. It is bigger. It's a bigger equation than most people think. So the deficit, I think, is scaring the markets, but the Federal Reserve is coming in saying we're going to lower rates. So the markets are basically in turmoil right now. Then another big pivot point is the election thing. I'm not even going there because, Democrats are basically going against Biden right now. Biden's staying in the race. He keeps telling us, the markets are saying, okay, what are we going to do if Trump gets elected because of tax cuts and all this other stuff? So the markets are basically, it's so uncertain right now that we're trying to find a direction on where things are going to go. So please just pay attention daily on my videos. I'll give you the content, the economic calendars of the day, so you can kind of, monitor what's going on with interest rates. So on our side, we don't know what's going to go on with home prices. Nowhere in the whole country, even my neighborhood, I don't really know what's going on. So our content is basically helping you guys determine, what financing options do you have that might put you in the best position to get the most affordable housing payment. And we can talk about programs, down payments, and all those other things. But
So for
that's
someone,
basically it right now.
yeah, for someone who's in the position of they're considering like locking or floating, what would you say for the next like month or so?
It's tough because, for example, it's when you're closing. So, for example, I just reached out to a borrower we have that's closing in 2 weeks, and I've been floating his rate, thinking, okay, I'm just going to wait for a little bit of a nice little dip like we're seeing right now. I thought it was going to dip a little bit more potentially, but tomorrow we have a huge inflationary number coming out, or data coming out. So it's not like, hey, what's going to happen in 2 weeks? In this case, is what's going to happen tomorrow. So there's so much volatility in the market, but generally in terms, if you're looking out 30, 60 days, my expectations are rates are going to gradually stay where they are or gradually retreat back just a little bit. But again, the uncertainties out there are, our government politics, all this other world uncertainties, wars everywhere, and everything else. So it's just it's a weird situation to be in right now.
Cool. Let's see.
Did I
Well,
answer
not
your
cool that we're
question?
in
I
a
hope
weird
I did.
situation, but
Yeah.
yeah.
It's just it's odd, and you watch even like the news channels, and they're like, the stock market's going like crazy, and things like that. So let's just keep going on.
Yeah.
But if you guys will, let us know where you're watching from, because our whole goal is to get people from New York all the way to Southern California on the channel. So if you can just let us know where you're watching from, you can just say the state if you'd like.
Cool. And let's see, until we have some questions here to run through, do you also want to cover a little bit of some of the grants that we have as well? So maybe we can do an overview of, we have 3 national grants. And then we also have a new Illinois grant up to $10,000 that I'll let you cover, because that's your domain a little bit better. Kevin said, let's get Dan to 30,000 subs.
I'm at 29,700. So
you're really
add
close.
in there, guys. I'm getting there.
Oh, we have Ethiopia. Interesting.
No kidding. That's awesome. If it's true.
Watching from San Diego. Yeah,
Thanks,
I hope we can only do loans in the U.S. Just a quick heads up there. Nina said, live in New York, looking to buy in New Jersey.
We need questions, folks. That's why we're here. What was the question? I think you asked me something, or did you?
About the grants.
Yeah. So the first one, and I think a lot of people find it on your website and your channel because you have a couple 100,000 more subscribers than I do. But would you mind pulling up the grant finder on your channel so we can go through that briefly? Yes. But while you're pulling that up, we just launched, I had the okay about a week or two ago to launch this. But we're working in the background trying to make sure we get all the bugs and everything worked out. We just are announcing a $10,000 grant program for those in the Chicagoland area. So it's not just Chicago. It's basically probably about 7-8 counties around that area. So if you're looking to purchase in the Chicagoland area, check it out. Maybe I can post that video out there or something like that. Or Kyle, if you wouldn't mind, I can maybe give you the URL or something, but I just posted it last night. It is a $10,000 grant program for those in Illinois. So check it out and see if you might qualify for that. But the qualifications are very similar to this. So if you want to check out the grants that we offer, there's probably thousands of grants out there. I hate to say it this way. Most of them are terrible. Okay. Most of them come with it'll give you a much higher rate on the first mortgage, the mortgage you're getting. Then they'll give you a grant or a loan in many cases that needs to be paid back, or it sits there for a while or whatever. You can't refinance. You can't you're kind of stuck. The grants we have on here are, I hate to say, mostly free money. because there's no lien on your property. There's no payback periods. There's nothing. The Illinois grant does have a 5-year period where if you don't do anything with your house in 5 years, you don't pay it off or sell it, you don't have to pay it back. You can even refinance it, your current loan, and you don't have to pay it back. So a very unique program here in Illinois. But the rest of it is, Kyle, you can take it away if you want to go from here.
Sure. So basically, we have this tool here on the website, whenthehouseyoulove.com/grant. It's also right here. So what it does, it's going to ask you a couple questions. So is it just you on the loan, or do you have a co-borrower? Also, what your credit score is. The minimum for all the grants is a 620. And then, or I'm sorry, for one of them, and then others do have a little bit higher of a credit limit. So we'll just put in, I don't know, 720 here. Then it asks if you're a first-time buyer. And then we also have 2 of the grants that are based off of where you currently live. So let me see if I have all of them in here. These are all of the areas that qualify here. So it covers quite a large amount of the U.S. There's around, I think it was 12,700 areas, different GeoIDs that these grants cover. So it covers a pretty wide range here. So I'll say, yeah, we currently live in one of these areas. And then it has to be validated based on a census tract. So I walk through the instructions on how to do that here. It takes you like 20 seconds. It's not as difficult as it seems. What I'm going to do is I'm going to put in just a sample one so we don't have to run through that here. Then it's going to ask what your income is. So I'll put that in, where you're looking to buy, and then also a general range of a purchase price that you're looking at. If you don't know exactly yet, you can just put in an estimate. And then we're going to run off of the minimum down payment here. And I can see maybe I need to zoom in a touch more. So from here, what it will do is it's going to show you grants that match your profile. So all of these grants here are fully forgivable, meaning as soon as you close on the home, you never have to pay that money back. Technically, just as an extreme example, you could close on your home and then sell it the next day if you wanted to, and you would never have to pay back that money. So fully forgivable, there's 0 repayment, and then you sell or refinance at any time. And the rates on these are comparable to just a standard conventional loan. So we have one grant here, it's called 1+, and this is where you do 1% down and then you get a 2% grant. Now, what this grant finder will show you is if you can't qualify for a certain grant, it explains why. So for instance, in this situation, our income is too high for our county. So what you could do if you wanted to is maybe you're looking in, this county, you could look through other counties and see if you could potentially purchase in a county that you'd be able to be under the income limit. That's a way to kind of hack it a little bit to see if you could qualify in different areas. So for instance, I put in 80,000 as our income. Well, maybe if I look at buying in Warren County, I would be underneath the income limit. Okay, let me actually uncheck this box because that's a long list. Then we'd be able to qualify for that grant. So it gives you some help, some tips on why you might not be able to qualify. Then there's also Purchase Plus, which is $5,250, and then Home Ready First goes up to $6,500. So basically, out of these options, you obviously want to choose the one that gives you the most amount of money. And so what you can do is click Apply and then apply with our team to take advantage of these grants. And then we even have a cost estimate with these as well. So you can take a look at estimates of the down payment, closing costs, the total before the grant, and then with these grants, an estimate of what the total due at closing would be, including the credit. That way you can get a projected idea of how much it would cost to buy a home with the grant. And then some of these grants as well, like Home Ready First, has an appraisal credit of $500 and a home warranty credit of $500 in addition to the $6,500. So again, that's whenthehouseyoulove.com/grant, and it will walk you through all of this here. Dan, did you want to go through the Illinois one?
Yeah, we can go through it. I can point out kind of the perks of it. The biggest challenge with a lot of these grant programs is the income. Okay, so the Illinois grant, the weird thing about it, I guess I'll say, and Kyle and I were talking about it, is it takes into consideration your household income. Okay, a lot of these other programs, it's just whoever's on the loan, it's their income to qualify for the program. Well, the one then in Illinois is kind of unique. anybody over the age of 18 that's working in the home, that income is added into the equation to see if you exceed the income limits. Okay. But the benefits of this thing is you can use it on any loan program. Okay. You can use it on conventional, FHA, VA, and USDA. Okay. That's number one. Number two is you can use it on a single family home, a 2-unit, a condo, and manufacturing homes. So those two pieces are unlike a lot of other programs. Now, here's another one. A lot of times what the grants will do is it's kind of a secondary lien back behind your primary loan. Okay, so let me explain it to you. Here's how loans work. You're going to have your primary loan, number one, that you get, the main loan on your property. Okay, then you're going to have the secondary loan. All right. What happens though? Let's say this rate that you get on your primary loan is 6.5% or 7%. Okay. And rates go down to 5.5% next year. And you're like, hey, I want to refinance this thing so I can save some money. Well, most of the grant programs, what they're going to require is you pay off both these loans. You pay off the primary loan and you pay off that grant or that down payment assistance loan. Okay. These are the ones that aren't forgiven because there's thousands and thousands of them out there, but most of them aren't forgiven, meaning it's not basically free money. The one that we have, you can refinance. Okay. So the nice thing about that is, let's say we close you and your rate's 7, and then rates drop to 6 and you want to refinance. Well, we can refinance this loan, and the grant loan, they'll do what's called subordination, which they'll allow us to refinance the first loan and allow them to stay in what we call second lien position. So how lien positions work, I know I'm going a little in depth here, is your primary loan is your first mortgage. And then that grant or that down payment assistance loan would be your secondary mortgage. Okay. So what happens is when you pay off the first mortgage, you refinance it, automatically the second lien goes in first position. Think of you're in line to buy a ticket. The person in front of you is number one. They buy the ticket, they move aside. Now you're number one. Well, what this subordination allows you to do is it allows you to cut in line. So meaning the whole gist of this is you wouldn't have to pay off the down payment assistance loan or grant that we would give you. So, because you don't want to touch it for 5 years, because after 5 years, the whole thing's is forgiven. So that is a great program to have. And again, if you stay in your house for 5 years or more, even if you refinance, the loan gets forgiven. Okay, so it's a great program, and we just launched it. So we have $1 million to use up. We got that from the Federal Home Loan Bank because Serve Bank, we are a federal bank, right through here, right over here. This always confuses the heck out of me.
It's flipped.
And we're launching it. We just sent out a video yesterday, and we're waiting for the applications to start coming in. I don't think a lot of people know about it just yet. I launched it last night. So a lot of people say, Dan, you're a hypocrite. You complain about all this, free money from the government and so forth. Okay, yes, maybe I am. But we got $1 million to use to help homebuyers in the Chicagoland area. A far cry from a lot of the billions of dollars that's being used up in a lot of the government pieces of the equation. So just wanted to throw that in there. So, I'm not trying to be a hypocrite. I'm just saying, hey, the Federal Home Loan Bank of Chicago gave us $1 million to help you guys buy homes, and so we're going to use it.
Well, I think the difference is that money's already been set aside, and it's a like use it or lose it type thing more than a like we created it out of thin air.
Well, I never knew. I never really knew the Federal Home Loan Banks. They're required to take 10% of their profits and push it back into markets. So since we're in Chicago and we're a federal bank, we get money from the Federal Home Loan Bank like this to help people buy homes. And if you're in the Chicagoland area, even in the far suburbs, give us a call. We'd love to help.
We have Colton in here. We have Oklahoma City. Let's go through some questions here. Maybe we'll do a nice little speed round here. George said, George from Arizona, would you rather have down payment assistance with a higher interest rate where essentially you're paying back the assistance, or a bank grant, say, of $10,000? In general, I guess it depends a little bit on the terms. How much higher of an interest rate are we talking about? In general, I would prefer to have a grant where there isn't strings attached, especially because with a lot of down payment assistance programs that have like a second lien or you're paying them back, often there's restrictions on refinancing. had a borrower, this is a couple years ago, when rates like went from 5.5 down to 3. They were stuck in a DPA like this, and they weren't able to refinance because that specific DPA had like a 5-year requirement where they couldn't refi or sell without paying the whole thing back. And they're like, well, we're not going to pay the whole thing back. We can't do that. So we're just not going to refi. And so that's a little bit of my fear with some of those DPAs versus a grant is just completely yours and you never have to pay it back.
Well, and that's what I was saying in this one. It's kind of unique because you can subordinate. And I dug through those guidelines. Remember you and I last week, we were diving through the guidelines and it's like, hey, this will fit 2 units. Hey, this will fit FHA. And we're like, man, because we got the money. And then when it's like, okay, how do we promote this? Is it really all it's worth? And it was like, well, we start finding all these elements and it was like, hey, this is pretty cool. So the biggest thing there is like you just said, you can refinance and that lien would be subordinated. And surprising enough, right before we went live, I just got a request or an email from somebody looking to refinance. They close in October at a rate of 8.125. So I did a refinance video last week and it went flat on its face and everybody's like, hey, great video, but I think it's just bad timing. Well, I'm hopefully helping out somebody.
Max said, at what interest rate do you think sellers could come off the sidelines in a meaningful way? When this happens, do you think due to price discovery?
What do you like? Correct meaning go bad or what? Here's my take on it. We saw a little glimpse of this in October, November, December. Okay, what happened during that time frame is rates went to 8% or over 8% in October. I never thought I'd see that again in my life, but we saw it. And that's what I was just saying. There was a young man right before we went live that just emailed me and he's at 8%. So what do I think will take people, off the shelf from, and sell their homes? Even if rates come down, it's going to be sticky still because where do you go? Okay. So you're still buying houses at, higher prices than you have currently. So I think when rates, what we saw last October is when rates went into the 6s or trickled in the 6s, the floodgates opened up. So I think it's going to be a little bit lower than that now. So I'm thinking in the mid 6s, you'll start the activity picking up quite a bit.
Yeah. Jeff said we bought a house in January of 2023 with a 2-1 buy down, thinking rates would be lower in January 2025. Jokes on us. That is a bit of a
don't pull the plug yet, buddy.
At least the benefit is here is you still were able to use that credit. Like you still got 2-1 buy downs for the average price end up being somewhere around 2% of the purchase price. So you still got a 2% credit from the seller to help with your monthly payment. So you do have that money still. So it wasn't a complete loss, but yeah, the refinance opportunity not coming, is never guaranteed with a 2-1 buy down. And so we're always careful to make sure when people are looking at a 2-1 buy down that it's not, you have to plan on qualifying based off of the note rate and not just be comfortable with the lower monthly payment in the first 2 years, because there's no guarantee that rates will come down in the future and you'll be able to refinance and get a lower interest rate. So it's not a complete loss, but I understand your frustration.
I get it.
Artem says, thank you for your work. Thanks. And thanks for being here.
Thanks for joining us.
Dave said, is it better to ask for $10,000 off the purchase price of the home or ask the seller to put $10,000 to buy down the rate? You want to take it?
Good question. What would you do?
100% buying down the rate is going to always save you thousands of dollars. The purchase price, especially, is not going to change your monthly payment a ton.
Yeah.
Buying down the rate, $10,000 is a lot of money, and you might run into some restrictions on that based on how big the loan is. But that's going to save you the most amount of money versus changing the purchase price.
Well, here's my dilemma. Let's even the Fed's coming out. Now I know the Fed's been throwing us curveballs for a year. So that even the last person that quoted, I feel bad because it's like, we take the Federal Reserve's direction and they kind of threw us,
I see where you're going.
Air balls lately. So I don't know if I would spend, if I did a buy down, a rate buy down, I would not do I would not do a permanent buy down in this market. Okay. And the reason being is, the Fed's eventually going to start dropping rates. Okay. So I would use, I'm at odds on that one. Because if you spend $10,000 and you buy down the rate, and then let's say next year rates come down to the rate that you're at anyways, you kind of blew that 10 grand. But 10,000 off the purchase price isn't a ton of money saved in your monthly payment. So I'll defer to what Kyle said.
Yeah, no, that's a really good point. I think what I was saying is from a purely like math perspective, buying down the rate is always the best option. But when it comes to timing the market, so basically if you're not timing the market, buying down the rates is the best. But if then you're looking at, like Dan is saying, we're expecting rates to come down, and then could you get the rate a year from now for free for the one that you paid $10,000 for now, and you also got 10% off the price? Maybe, but that's where the risk comes in of like, are you willing to take that risk?
Who's the last guy that just came in? I feel bad, but it's like, okay, come on rates, you know?
Yeah.
But expectations are, I mean, the rates will eventually be coming down. But again, the video I posted this morning, I'd highly suggest you guys watch it. It's amusing and I think very informative.
Oh, okay. Aztec Panda said, me and the girlfriend are kind of hoping rates stay high for the remainder of the year to deal with less buyers. Hopefully negotiate price of homes that stay listed for longer. Is this a good strategy? There are a few people that are doing that, who are taking high rates as an opportunity if they have the ability to afford the payment, to get into a market where there might not be as much competition versus when rates lower, like Dan mentioned, when we saw rates take a little dip over the past couple of weeks, or a couple of weeks ago, we saw a surge of purchase applications come in. What are your thoughts, Dan?
It's another one of those things. It's like, I don't want to, it's hard to time the market. It's hard to time the market price wise. It's hard to time the market when it comes to interest rates. But I get what you're saying, because again, the only data we can go off of is October to December, when rates went from basically 8 to almost 6.5. It was a huge drop all of a sudden, and the floodgates opened up. So what's going to happen this time? I just don't know. I mean, there's homes out there. Inventory is growing, which is really good. I also did a video the other day, is inventory growing too much? You might want to check that one out. And, so I don't, you guys are stumping us. They're stumping me today.
Wait,
yes, it's nice.
You know what you need, Dan? This is why you're struggling with it. There we go. There it is.
Oh, there we go.
Okay, now I know
the answer. I would buy right now at the rates they are today, because in 3 weeks rates are going to come down. Okay, that's what the ball told me.
Oh gosh,
it's a weird market, folks, and that's why we don't come on here ever and tell you got to buy homes. Our goal here is to help. Well, we're not doing a very good job at it today, but help you navigate this environment. But some of these areas too, it's like, where do you live? If you live in an area where probably going to get crushed here shortly. And when I mean crushed, I'm talking, maybe a 5% haircut or so. Maybe you sit on the sidelines. I don't know.
Dan the Dirt said, hi, y'all.
Dan in the Dirt.
Had a structural inspection on the foundation today, and it didn't go well. Man, sorry to hear that. Keep us updated on it, though. What particularly didn't go well about it? Is it fixable? Is there any good remedy to it that's not going to cost a ton of money? Although usually structural starts to become a big deal breaker, I feel like most of the time. Slim Shady KP said, my loan officer says that grants tend to dry up as the year progresses. Is the beginning of the year best time to apply for a mortgage for availability of grants?
No. For example, ours is, they give it to us. Well, it depends on what kind of grant it is, because the grants that we have on what Kyle just went over, we've had those for, how long have we had those? Probably coming on a year, maybe not that long, but quite a bit
8
of time.
months, maybe.
But then Cal Heffa.
Yeah, that was like 11 days. No, 3 days.
It's something like that. So the money we just got from the Federal Home Loan Bank, it's $1 million. So it 10,000 a piece. So we can do 100 loans. So once we do 100 loans with that program, it's over. That there's no more money until, like you said, next year. But a lot of these programs, they have I don't know how they do it, but they've been going on for a year or two or three. So the three grants that Kyle went over, we've had it. I know at least since the beginning of the year, easy.
Yeah. If we notice those grants start to run out of money, we'll let you know. The issue with the way that the grants run is they don't like publicize how much money is available, because it's through different like federal banks. They're not like, here's how much we have left to go, but they do give an update if something's going to run out. They're not just going to like cut it off and say good luck. So we'll mention if it's at the end of its life. But yeah, at the moment, we don't anticipate them going away anytime soon. Kevin, I closed on my new build on the 31st. I locked in at 575 and got a 2-1 buy down. So my rate for the first 12 months is going to be 375. I hope rates drop before
That's awesome.
I close to see if I can get a lower rate. Yeah, that's sweet. Are you FHA? I've been noticing a lot of builders are doing these FHA. They're switching to FHA loans to give the impression of a lower rate. Well, I mean, it is a lower rate, but compared to conventional, and it's not being looked at conventional versus FHA, it's just a low rate, and people aren't realizing this in FHA mortgage, or maybe they're not as upfront about it. Have you been noticing that?
Yeah, and it's crazy. I got one from Pulte this morning, and somebody was going with Pulte. Pulte's giving them, I think it was $15,000, and they're using almost all that money to buy the rate down to what I could get them today with no buy down. So
yeah.
And then they put you in FHA. FHA charges you 1.75% of the loan amount to just insure your loan. So it's good if you have a mid to low credit score, under 700, under 680. FHA might be the way to go. But if you have a 740, 780 credit score, you're going to pay 1.75% of the loan amount just because you're getting an FHA loan. So you have to factor that in.
And mortgage insurance for the life of the loan.
Yeah. You'll have mortgage insurance forever. And the only way to get rid of it is you have to refinance. So you have to consider all that. And these are the areas that a lot of people don't understand or don't know. That's why we're here. But we don't know what you don't know. So that's why we need the questions so we can answer them. Even if you think it's a dumb question, please ask it.
Oh, Dana the Dirt said, fractional reserve banking, the Federal Reserve Act is a scam. Thomas Jefferson warned against central banks.
I hear that a lot, but I wonder what would happen if we didn't have a Federal Reserve. Just throwing that out there. We don't have to answer that, but I don't know what ramifications that would cause.
Ooh, I don't know. Colton said, if the Fed cuts rates twice this year, how would that translate to mortgage rates? That's a great question.
So, yeah, it is a great question. You want me to take it? You want to take it?
Yeah. Okay. I'll even restart your timer here. There you go. A fresh 60.
The tough thing is what we get asked every week is, where do I think rates are going to go? Okay. And the name of my channel is The Rate Update, and I need to change it. And I'm asking Kyle for some help with that. If you guys have what we can name my channel, I don't like The Rate Update because it just looks like we're after rates. Our whole goal here is to educate you guys on wealth management, wealth creation, real estate, and things like that. Here's what I would say. Normally, you would take the 10-year Treasury, okay, and add 1.5 to that or 1.75% to that, and that would be the rate that your mortgage rate would be, okay, on average. So if the Federal Reserve cuts rates by, let's say, 2 times, and they do each time by 0.25%, I'm doing this as generically as I can. The 10-year Treasury right now, you are just going to pull up on my screen. So let's assume that the 10-year Treasury then drops to 3.75. Okay, so now we got 3.75 is the 10-year Treasury. Let's add 1.75 to that. That would give us 5.5 is the rate. I don't think we're going to get to 5.5. So that's how historically you would look at these numbers. But again, with their federal deficit, adding all these bonds and all this debt to the equation, we're going to be higher than that. So if you take that and just cushion it another 50 basis points, that would put us about 6%. So if they cut rates, I could see rates being between 6, maybe 6.25 after the 2 rate cuts, and then kind of, going from there. That would be, I think, also enough to kind of open up the housing market, because we have the inventory now, and the inventory is growing. But again, it's not, you see these videos, the inventory is up 1,000%. Well, please make sure you understand what the baseline number was. If you go, the videos, remember videos not too long ago, Kyle, you'd see foreclosures are up 5,000%.
Yeah, that's what I was thinking.
We had a moratorium on foreclosures during COVID, so you couldn't foreclose. Now, some people did get foreclosed on, but you basically didn't get foreclosed on. So let's say that went to 1,000 people got foreclosed on, and then it went to 2,000. Well, it's up 100%. But so you get what I'm trying to explain is, it depends on the base that you're in. Okay, I'll shut up. I'm talking today, I know.
I follow an appraiser in Sacramento, and he had something about that too. When the moratoriums got lifted, there were articles about foreclosures are up. It was like 14,000% or something, or maybe it was 1,400. Yeah, I think it was 1,400. And then he's like, but if you look at the data, it went from one foreclosure to like 14. I'm sure I'm not doing my percentages correctly there, but it was like, that's you can't lead with the percentage and scare when it's not statistically significant data underneath.
And you see these thumbnails, foreclosures up 1,800%. And I try to, when I'm doing my videos, I'm trying to do it as a person that just doesn't really, they don't do this for a living. They're looking maybe potentially buying real estate. Now they're starting to watch videos and things like that. So when you start seeing a lot of that data, it would scare the heck out of me thinking, okay, my market's going to crash. I'm going to lose my job because these videos are telling me the unemployment rates are skyrocketing. So I'm going to lose my job. I have no money and I'm going to be homeless. If you watch a lot of these videos, that's what it appears to be. The economy's terrible. You're going to lose your job. Because you're going to lose your job, you're going to lose your house and the housing market's going to crash. Okay. I don't know where I'm going with that.
All right. Will said, shout out to Lancaster.
I know where Lancaster is.
I'm planning to put builder credit towards my closing costs and upgrades so I can rate hack and pay off to 20% equity sooner. How does that strategy sound? Planning to put builder credit toward closing cost upgrades. It sounds like a good strategy to me. I don't see anything wrong with that. Really, I think that's what most people put the builder credit towards anyway, is closing costs and upgrades. Is there another way that you can use it outside of maybe a buy down? But if I was on all the
lenders, they're trying to get everybody to buy down the rate.
Yeah, I would personally, instead of a temporary buy down, I'd rather get upgrades on my house. That's just me personally. If the opportunity is there.
This goes back to the one question we had. Would you take $10,000 in upgrades or $10,000 to buy down the rate? So again, it's kind of when you're going to do things, Yeah. But if you guys are new, let us know where you're coming from as you guys join us. That'd be awesome.
JC Franco said, what are the mechanics of refinancing cost-wise? I know very little, but intuitively it feels like we would lose equity and turn our purchase into an otherwise renting situation. Interesting. I'm interested in the losing equity and turning our purchase into a renting situation. I'm not sure about that, but do you want to cover this?
Yeah. Refinancing's pretty simple, and it depends on if you have a government-backed loan or if you just have a conventional standard mortgage. Okay, let me explain each one of them. If you got just a normal mortgage, you probably know it. You don't, you would know if you had an FHA, VA, or USDA loan. So if you have a standard mortgage, refinancing it can be a little difficult because most cases you're going to need an appraisal done. Okay, that's going to cost you maybe $500-600. Your title fees are going to be there as well. That might be another $500 or $600. So that's $1,000 in fees. You might have about $1,500 to $2,000 in fees. Okay. But there's a lot of pieces of that puzzle. You still have to qualify for the loan. What I mean by that is we need an appraisal, we need your pay stubs, we need to validate your income and all this other stuff. If you have a government-backed or government-sponsored loan, it's simple. There's no appraisal needed. There's no income needed. It's just paperwork, and we'd love to help you with that paperwork. And that's as long as your rate's coming down. What they're looking at is saying, well, you're paying us fine now. So if you're refinancing and lowering your rate, thus lowering your payment, we're okay with that. So we don't really need to revalidate anything from you. Just it's a bunch of paperwork just to transform that loan over to a new loan at a lower rate.
Mhm.
So I don't, you might lose equity because you roll in the closing costs or something, but other than that, and then renting, I don't understand the renting situation. So if you can explain that, we'd love to answer that as well.
Kevin said, besides from hard money loans, what's the best financing option for buying flips? I've heard people buy with a HELOC. How does that work? So we do have some products that are fix and flip type loans. So I would say hard money is more difficult, expensive, and then fix and flip is a little bit beneath that. It's not quite hard money intensity and scrutiny, but effectively it's a commercial loan. So it is going to come with a higher rate because it's fix and flip, but then think of it like a bridge. You use that loan to fix it, flip it, and then you either refinance it into a long-term loan to rent it out, or you just sell the property, which is what a lot of people do. So that's an option on the commercial side. And then HELOC is really the easiest way. If you have equity in your home, basically what you'll do is you'll just get a home equity line of credit. And it effectively is like a credit card against the equity in your home. So for easy math, let's say your home is worth $300,000, and let's say you owe $200,000 on your home. Well, there's $100,000 in equity, but a bank will usually on a HELOC only let you go up to about 80 to 90% of the value of the home. So let's just say you want, I don't know, $50,000 in repairs. You might have enough equity where basically you can open up a home equity line of credit. You get a limit for that amount. So you'll get approved up to a certain credit limit, just like a credit card. So it might be $50,000. The nice thing about a HELOC is you can do whatever you want with that money, which can be a little bit dangerous. Obviously, you don't want to go buy a bunch of stuff that you don't need. But for things like flips, it's really nice because you don't need someone who's going to tell you repairs that you can and can't do, versus like hard money or some of these fix and flip products can require an inspector to actually come out and make sure that the work is approved. You can't just do whatever you want. Versus a HELOC, you can kind of do whatever you want with it. And it really is like a credit card. So and a lot of HELOCs come with a card that you can use. So you only take out a loan basically for how much you're spending. So you don't have to pull out a lump sum of cash. Just as you're spending that money, it increases the balance, and then you pay it down over time. Also, the HELOCs, most of them have a 10-year interest-only period, and then you have a 20-year payback period after that. So that can be helpful as well to reduce the monthly cost as you're looking at a flip. Dan said, oh, man, $50,000 on the high end for the foundation repairs or structural. They didn't do piers or concrete correctly. Man, that sucks. Well, are they? Is the seller going to cover the fix? I'm going to assume they're not going to do that.
We might want to do at one point. I don't know if any of you are on here. If you can give us a thumbs up. Are you interested in investment properties and in the last person fix and flips and things like that? That might be something we want to dig into, because I talked to somebody in California that's a huge investor. And they're like, we are doing DSCR loans like they're crazy. People are buying rental properties right now. And the nice thing about doing it that way, and this is what reverts back to that last question that you had, is it allows you to put it in an LLC. I after the last crash, I'll give you my personal take on a lot of this stuff. I took a home equity on my home, and I was in the middle of about 6 fix and flips, and the market crashed, and I lost my ass. Thank goodness I was able to pay everything back and all that other stuff. But a technique to use now is, as you're buying these properties, put it in its own LLC. And if something really goes bad, you can basically bankrupt that LLC and not really affect your person. That might be an option.
Don't a lot of those still have warm body recourse though? Even when you close an LLC?
No, not that I know of on the DSCRs. They'll allow you to put it in there, and it's a completely put it in your LLC and everything. I'll take more of a deep dive into that, but that's what we don't do a lot. We do like one every couple months. And so I was talking to a big investor in California. They're like, we're killing it right now on these. So that's one of the reasons why I was going to talk to you about it. But if you guys are out there and you're an investor, give us a thumbs up so we know that you're on here as an investor. Be interested to see that.
Hey guys, thanks for the advice as always. Looking for homes maximum 1 hour from Austin and considering manufactured mobile homes. Anything unique about lending options for these types of homes? Yeah, especially on the mobile side, can start to be a little bit tricky. So at the moment, we're not doing mobile homes. Really, we can do manufactured homes that were basically treated as if they were just a standard home, like a standard stick-built home. Like they got moved to the property, never moved again. There's no wheels, there's no hitch. So those are options that we can do. But when it's mobile and it actually has effectively a title that's closer to like a car title, you need a chattel loan, which is basically like a large personal loan effectively versus a mortgage, a standard mortgage. So I wish there were easier options for mobile homes, because especially as homes are becoming more unaffordable for people, that could be a good option because there are some like really nice manufactured homes. But unfortunately, lending hasn't really caught up.
You mean mobile? Mobile?
Yeah.
The tough thing about mobile is they're mobile. So, think of you're the lender and you lend on this thing and then they don't pay and you go to foreclose and you go to the place and it's vacant land. They picked up the house and moved. That's the only thing I can think. And it also most of them have a VIN number, a vehicle ID number, not a tax, like a parcel tax number.
Dan said no footers on the perimeter. Bad concrete pouring on the piers on the joists were nailed on the side, not under the floor joists. Well, at least you know now.
Dan, I checked out your channel. Pretty cool, dude.
What's the channel? Or what's he do on the channel?
You can see it. It's neat. Sorry.
Let's see. I bought a home and we've been paying minimum payments while DIYing minor renovations. I'm looking to do some bigger renovations like a kitchen rehaul for $15,000. Should I save cash, finance, or wait? You want to take that?
It's how bad you need those renovations. $15,000 isn't a lot. What you might want to do is call your local bank. If you're looking, I'll just put this carte blanche. Anybody out there, if you're looking for a home equity loan, call your local bank that you do your checking and savings with. See if they have a free, basically, home equity loan, because a lot of times they'll give it to you for free, or it'll be very minimum costs. K1K, 4KU. The reason why I say that is 15 grand. It's a lot of money, but it's not a lot of money. Okay. So that would be probably the best way to do that. Unless you can save up for it, but I don't know what your savings plan is, how long it'd take you to save the cash up. But the easiest and quickest way would be to just call your local bank and see what they have in regards to a line of credit, a cheap line of credit.
How many pay stubs are needed when job is changed in the same field? So if you're changing in the same field, usually an underwriter wants to see at minimum 30 days worth of pay stubs. So it depends how you're paid. Usually that's 2 pay stubs for most people who are paid biweekly. If it is the same field and same rate of pay, then you probably won't run into any issues. The only issues you may run into is if you're making less money. So if you have a lower rate of pay, an underwriter may want to have a little bit more scrutiny on that. I will add to that as well. This is for like base pay. If you have things like overtime or commission, then things start to get a little bit more tricky, and underwriters want to have a longer time frame to see that you're able to make a similar amount of overtime or commission bonus in that new field. Daniel said, would you recommend to make my first home an investment property in a few years once I pay down some of the mortgage and then get a second home, or sell the first home to move somewhere else?
My oldest son is actually contemplating this right now. He's got a starter home. It's already got built up a good amount of equity. His payment we refinanced him when rates were virtually zero. So he doesn't want to get rid of it. I don't blame him. The thing you have to ask yourself, Dan, is do you want to be a landlord? That's the only thing. that I would just ask. If you have no problem being a landlord, I think you're going to cash flow well. I would get a home warranty on my home, just to cover yourself for all the things that could happen to it. A home warranty is fantastic. I have one on my house here in Chicago and one in my place in Florida, and they're probably at my house once a month, one of these places fixing something. And my air conditioner just went out in Florida. They went down there, and it was a $65 service call to fix it through my home warranty. So the one thing I learned over my life of other properties and investments and things like that, get a home warranty. Money well spent.
Dave said, if I go shop for mortgage rates, is it possible to ask one lender to beat the lower interest rate I got from the other lender? Do you want to take that?
You want to take that? Yeah, I can take that. He shouldn't be. It should be illegal. And basically, here's what drives me nuts. We get these every day. So, Kyle, can you pull up your website where they can upload their loan estimate? And I get these every day. People upload their loan estimate to me, and then I'll say, okay, well, here's what I could do. Right there. So people upload their loan estimate to me. I go through it, and I tell them what I can do. 99% of the time, we don't get it back because they go back to the other lender and they're like, yeah, we'll get you that rate. Well, why would you even go back to them? And I get why you do it. But the tough thing I find is they wouldn't have given you that lower rate or lower fees if you didn't reach out to us. So it's just a trust issue with me. If I went to somebody and they wanted, I got a pool, I just had to put a liner in. The guy I always use was $2,000 more than another place. The other place quoted me. I didn't even go back to my guy. I'm like, I'll take that because I'm expecting my guy to give me the best deal right up front. And if he didn't, shame on him. So do I look at that wrong? I mean, what's your opinion?
No, I don't think so.
Okay.
It's one of those why didn't you give me the better rate the first time?
Right. So I didn't trust you at that point because you weren't looking out for my best interest. But now I called you on it, and now all of a sudden, now you got my best interest in mind. So legally, they should not be able to. But does it happen? It happens every day.
Dan said we're waiting on the structural inspector to submit the estimate to our realtor. Then to the seller's realtor, if he says no, we're going to walk away. Totally understand that. Nothing worse than buying a house with structural problems and a $50,000 repair bill. Yeah. Kevin said, I'm interested in investments. I think DC is as well, or hello from Scottsdale, Arizona. Let's see. Triple J Zoo said, closing on a house next Monday, 20% conventional, 6.375. I'm considering canceling escrow in the future. What are the pros and cons of canceling escrow, and when should I do this? I do actually, I have a video that is coming out this week about escrow that may be helpful. Really, pros of having an escrow account is that you don't have to worry about your taxes and insurance. Your lender's going to handle that for you. You just pay monthly installments to your lender. They put it into a separate account, and then they pay the insurance and tax bill for you. The only downside to canceling escrow is you just have to make sure that you save so that when your tax bill comes due and your insurance bill comes due, that you have money to pay it. Because sometimes tax bills, maybe it's even for 6 months might be $2,000, and you don't be like, I don't have $2,000, and then you're behind on a tax bill. So as long as you're good with budgeting and saving, waiving escrow in the future, I think is perfectly fine. For most people, tend to have things more on the convenient side, and maybe aren't able to save as easily. And so an escrow account benefits them a lot more. So other than that, there aren't like cons to not having an escrow account. Just don't get late on your tax or insurance bill.
Because there's some hefty, especially insurance. What you don't want to do is if you don't escrow and your insurance lapses, what the lender will do, they'll put in what they call forced place insurance. And that I know our premiums are already crazy, but the premium on those are usually about 3 to 4 times what your current premium is. So please don't lapse on your insurance.
Yeah. Is buying a house in an HOA a good deal, considering some HOA fees are higher? To me, it just depends on the HOA itself. And how much do you love the house? Are you willing to pay the premium for the HOA? Is the HOA offering any benefits Before you buy a house, you can always ask for the HOA docs. And then when you're under a purchase contract, the seller is required to give you HOA docs so you can see how it's run, what are the rules of the HOA as well. So you can know what you're getting yourself into before you end up closing on the home. Because some HOAs can be super strict, and others it doesn't even seem like they exist. So it really just depends. How much hassle are you willing to put up with? Are they going to be blocking things? Are you like, I want to build a garage in the backyard or, through an alleyway or something, and the HOA says no, and you didn't realize that until afterwards. So, do you have any thoughts on HOAs?
They'll cut your grass. It depends on what the HOA does. Are they going to cut your grass, maintain the streets, the sidewalks? Are they going to paint your house? Some HOAs will take care of the outside of your building. Others don't really do anything. I had an HOA when I first bought my house that I'm in now, and it was like $200 a year. I've never paid it. Nobody's ever asked me for it, and even my neighbors don't know about it. So there's an HOA in my neighborhood, but it isn't even created. But then I have an HOA in Florida that's a completely different scenario. They take care of the pool, the beaches, all the maintenance, the elevators, the roof, everything else. So it depends on what you're getting, how much bang for the buck you're getting.
I'm not in an HOA, but I am in a historic district, and I did paint my house. I found out last week I was supposed to. Apparently, I live in a very strict historic district. I was supposed to get approval for that. It's fine.
But trust me, guys, most of you guys aren't going to live in the neighborhoods like Kyle lives in. Okay, just saying.
What, with a historic district with a bunch of people who are
I was waiting for you to yell at me.
Paint colors and stuff. Yeah. So I'm hoping that they don't say anything about it. Hopefully they're not watching this.
I'll ask a general question out there because we got a lot of people on here. Has anybody gotten their updated homeowners insurance? And how bad is it? Actually, I got mine this year, and it wasn't bad at all. But we're closing on a few loans in Florida. I just got a Florida policy. It was 5 figures for insurance. 5 figures, if you know what I mean by 5 figures.
Yeah,
that's a lot of money for insurance. So just saying. So if you guys have, let me give me a comment of how your insurance is going out there, because it can be brutal.
Yeah. Awesome. So if you'd like to get pre-qualified, or if you have more questions that we couldn't answer here, or maybe you just don't want to bring your question and have it up on screen, totally understand. What you can do is go to winthehouseyoulove.com and you can schedule a call with us. So it's free. There's no obligation to it. We're also not going to sit and harass you on the phone all the time. We don't have time for that. You don't have time for that. There is really low pressure. So it's not going to be super high pressure and you feel like you're in this whirlwind that often happens when you talk to other realtors or loan officers. So you can schedule a call. We work in all 50 states. And what we'll do is just answer questions that you have, see your scenario, what you're looking to do. And we'll help you figure out if there's any grants that we can get you connected with, what the best loan would be. We'll have you fill out an application. We'll show you your quotes. And then from there, you can shop for homes if you'd like to. And again, there's no time constraint that you have to, or this intense pressure. You can look for homes. And then if you're hey, I don't want to do this, or I want to sit out for a little bit, that's perfectly fine as well. So you can go to winthehouseyoulove.com, schedule a call with our team. You'll either be connected with Dan, Alan on our team, or David. And we're all licensed under ServBank. So again, we're not this huge, big call center. You're not going to get lost in the void somewhere. It's just our small local team. And we'd be happy to help you out. So winthehouseyoulove.com to schedule a call. Thank you all for being here. And we'll be doing the same time, same place, Wednesday next week at 3:30 Eastern. And we'd love to see you there.
Thank you so much.